Listen to me very carefully, because what I am about to show you isn't just a theory. It is a mathematical inevitability that is going to crush the average investor who is sleepwalking into 2026. If you are currently dumping money into an S&P 500 index fund or holding on to a generic 60-40 portfolio thinking you are safe, you are standing on train tracks, and the train is coming faster than you think. The strategy that made your neighbor rich in 2015 is the exact same strategy that is going to wipe you out in 2026. And by the time you realize the rules of the game have changed, it will be too late to exit. I'm not saying this to scare you. I'm saying this because I want you to survive what's coming. We have to be honest with ourselves right now. For the last 15 years, we have lived in a fantasy land. We had interest rates near zero. We had the Federal Reserve printing money every time the market sneezed. And we had a global environment that rewarded laziness. You could blindly throw a dart at a tech stock and make 20% a year. That era is dead. It is over. And the investors who are still acting like it's 2021 are the ones who are going to be liquidity for the institutions that are quietly positioning themselves for the reality of 2026. Today, we are going to break down exactly why the passive investing bubble is leaking, why the tax changes coming in 2026 are going to cause a massive sell-off, and exactly how you need to restructure your money so you aren't left holding the bag. To understand why 2026 is the danger zone, you have to look at the story of the average Joe investor. Let's call him Mike. Mike is a smart guy. He makes a good salary. He saves 15% of his income, and he puts it all into a target date retirement fund. He feels good. He checks his app once a month, sees the number go up, and goes back to watching football. Mike thinks he is diversified because he owns 500 companies. But Mike is wrong. Mike doesn't own 500 companies. He owns exposure to 7 massive tech giants and a whole lot of garbage that hasn't made a profit in a decade. Mike is relying on a financial system that requires constant injections of cheap cash to keep his portfolio green. But here is the problem Mike doesn't see: the debt wall. In corporate America, companies borrow money for 5 or 10 years. A huge chunk of the corporate debt that fueled the stock buybacks and the dividends you love so much was taken out in 2020 and 2021 when rates were basically zero. Guess when that debt matures? You guessed it, 2025 and 2026. This is what we call the maturity wall. These companies have to refinance that debt, but they aren't going to get 0% anymore. They are going to be refinancing at 5, 6, or 7%. That difference destroys profit margins. When profit margins shrink, stock prices crash. And when stock prices crash, the passive index funds that Mike is buying automatically sell, creating a doom loop that drags the whole market down. This is where the retention trap gets tricky, because you might be thinking, okay, but the market always comes back, right? That is the dangerous assumption. Yes, the market eventually recovers, but can you afford to wait 14 years to break even? That is what happened to people who bought the top in 2000. That is what happened to people who bought the top in 1968. In real terms, adjusted for inflation, they were underwater for over a decade. The year 2026 is shaping up to be one of those pivotal moments where we shift from a secular bull market to a secular bear market or a stagnation period. If you are 50 years old or even 40, you do not have 14 years to wait for your money to come back. You need to make money now. Let's talk about the specific mechanism that is going to break the market in 2026. And it's something almost nobody on YouTube is talking about because it's boring, but it's deadly. It's the expiration of the 2017 Tax Cuts and Jobs Act. You might remember when taxes got cut, corporate profits soared because they paid less to the government. Well, those cuts were temporary for individuals and passed through businesses, and many corporate provisions start to phase out or tighten up right around the 2025-2026 window. If taxes go up, earnings per share go down. It is simple math. The stock market is valued based on future earnings. If you suddenly slice 10% off the top of those earnings because of tax law expiration, the market has to reprice downward instantly. So, if you stop buying stocks the lazy way, what are you supposed to do? This is where we have to shift your mindset from being a passive accumulator to an active allocator. The wealthy do not buy index funds and pray. The wealthy buy assets that have pricing power and scarcity. In 2026, we are looking at an environment where inflation might not be 9%, but it probably won't be 2% either. It's going to be sticky, around 3 or 4%. In that world, bonds are trash. If you are holding bonds yielding 4% and inflation is 4% and taxes take another chunk, you are losing purchasing power every single day. You are literally paying for the privilege of losing money. Instead, you need to look at commodities and real assets. I know, it sounds old school, but look at the supply constraints. We have underinvested in energy, copper, and agriculture for 10 years because everyone was too busy investing in software companies that don't make money. But you can't build AI data centers without copper. You can't power electric vehicles without lithium and massive amounts of electricity. The demand for physical stuff is skyrocketing, but the supply isn't there. That creates a price squeeze. While the S&P 500 might be flat or down in 2026, the companies that dig stuff out of the ground could be doubling. This is the rotation you need to prepare for now, not when it's on the front page of the Wall Street Journal. Let's go deeper into the psychology of this. Why is it so hard for people to change? It's because of social proof. When you go to a dinner party, and everyone is talking about how much money they made in the big tech stocks, you feel like an idiot for holding gold or energy stocks or cash. But investing is the only business where when things go on sale, people run out of the store. When the S&P 500 is at an all-time high, that is the most dangerous time to buy. Yet that is when the inflows are the highest. You have to be willing to look stupid in the short term to look like a genius in the long term. In 2026, the people who look like geniuses are the ones who are building positions in defensive value and hard assets right now. There is another massive risk factor for 2026 that we need to discuss, and that is the liquidity cycle of the U.S. Treasury. The government is issuing debt at a pace that is frankly terrifying. We are adding $1 trillion of debt every 100 days or so. Who buys that debt? Foreign governments used to, but they are buying less. The Fed used to, but they are trying to shrink their balance sheet. That leaves you, the domestic investor, to buy the debt. As the government sucks more and more liquidity out of the system to pay its bills, there is less money left over to pump up stock prices. It is a giant vacuum cleaner sucking cash out of the stock market and into the bond market. This liquidity drain is going to hit its peak intensity right around 2026. So, how do you actually construct a portfolio for this? You don't go to 0% stocks. That's panic. You go to quality. You stop buying the index, which is weighted toward overvalued tech, and you start picking individual sectors. Look for companies with low debt. Remember that maturity wall I mentioned earlier? Companies with no debt don't care about interest rates. If a company has $1 billion in cash and no debt, high interest rates are actually good for them because they earn interest on their cash. These are the fortresses you want to own. You want companies that sell things people need, not things people want. When a recession hits or the economy slows in 2026, people will cancel their streaming subscriptions, but they will not stop buying toothpaste. They will not stop paying their electric bill, and they will not stop buying medicine. Healthcare, utilities, consumer staples, these are boring, but boring is what saves you when the bubble pops. I also want to talk about the role of cash. For the last decade, they told you cash is trash. Ray Dalio said it. Everyone said it. And they were right then. But entering 2026, cash is an option call on the future. Having 20% of your portfolio in short-term treasuries or a high-yield savings account isn't about the yield. It's about ammunition. When the deleveraging happens, when the margin calls go out and hedge funds are forced to sell good assets at bad prices, You want to be the guy standing there with cash ready to buy. If you are fully invested, you can't take advantage of the crash. You just have to ride it down. Cash gives you the ability to be aggressive when everyone else is terrified. Let's pivot to the business side of this, because it's not just about stocks. It's about your income streams. If you are running a business or have a side hustle, the easy growth era is also ending. Customer acquisition costs are through the roof. You can't just run Facebook ads and print money anymore. By 2026, the businesses that win will be the ones that focus on retention and lifetime value, not just growth at all costs. If your business relies on cheap debt to expand, fix that now. Pay down your variable rate lines of credit. Lock in fixed rates if you can. Cash flow is going to be king again. The growth at all costs mindset is an artifact of the zero interest rate phenomenon. We are going back to basics: profit, margin, and cash flow. Now, I know what some of you are thinking. You're thinking, but what about AI? Won't AI productivity save the economy and push stocks higher? It's a valid question. AI is real. It is a revolution. But technological revolutions often lead to stock market bubbles that burst before the real value is created. Look at the dot-com bubble. The internet changed the world, but if you bought Cisco or Intel in 2000, you got slaughtered. AI will change the world, but the valuations of the companies selling the shovels are priced for perfection. If they miss earnings by even a penny in 2026, the compression will be violent. You can invest in AI, but don't do it by blindly buying the most expensive stocks in the market. Look for the companies that will use AI to cut costs and boost profits, the boring old-world companies that will become more efficient. That is the hidden AI trade. We also have to talk about the geopolitical risk that peaks around 2026. The world is deglobalizing. Supply chains are breaking apart and being rebuilt closer to home. This is inflationary. It costs more to build a factory in Ohio than in Shenzhen. This onshoring trend is great for American jobs in the long run, but in the short term, it means higher costs for companies and lower margins. It creates a structural headwind for the S&P 500. You need to identify the companies that are actually building the factories, the construction firms, the machinery companies. They are the ones who get paid to rebuild America's industrial base. I want you to visualize your portfolio right now. Visualize a pie chart. If that pie chart is 90% stocks, and most of those stocks are in the technology sector, you are driving a race car without a seatbelt. It feels fast and fun right now, but if you hit a bump, you are going through the windshield. By 2026, you want that pie chart to look different. You want a slice for precious metals. Gold and silver act as insurance against the debasement of the currency. You want a slice for energy. You want a slice for high-quality, dividend-paying value stocks. And yes, you want a slice for Bitcoin or crypto, but strictly as a speculative hedge, not your life savings. Diversification is the only free lunch in investing, but true diversification isn't buying an index fund that is 30% Apple and Microsoft. True diversification is owning assets that move independently of each other. Let's address the psychology of holding on. The hardest thing to do in investing is to sell a winner. You look at your gains and you feel like a genius. But paper gains are not real. Until you sell, it is just numbers on a screen. Taking profit is not a sin. Rebalancing is not a mistake. If one part of your portfolio has grown to be 50% of your net worth, you need to trim it. You need to act like a gardener. You prune the things that have grown too wild, and you water the things that are undervalued. If you go into 2026 with an overgrown garden, the first winter storm is going to tear it apart. Think about the demographic cliff as well. The baby boomers are retiring en masse. They are moving from being net buyers of stocks to net sellers of stocks to pay for their retirement. This creates a natural, persistent selling pressure on the market that we haven't seen before. Who is going to buy those stocks? The millennials and Gen Z? They don't have the capital yet to absorb all that selling. This supply-demand imbalance is another reason why index returns could be flat for a decade. You have to be smarter than the crowd. You have to be nimble. So, here is your action plan for the next 18 to 24 months leading up to 2026. Step 1. Audit your leverage. Get rid of high-interest bad debt. You cannot invest your way out of a 20% credit card hole. Step 2. Audit your exposure. If you are heavily concentrated in the Magnificent Seven, start paring that back. Move those profits into defensive sectors like energy, healthcare, and utilities. Step 3. Build your cash pile. Aim for liquidity. Step 4. Educate yourself on macroeconomics. You don't need a PhD, but you need to understand how interest rates and the dollar affect your money. The dollar is the wrecking ball of the global economy. When the dollar is strong, assets tend to suffer. Understand that relationship. This isn't about being a bear. I am an optimist on America, and I am an optimist on capitalism. But I am a realist about valuations. The price you pay matters. Buying a dollar for 50 cents is investing. Buying a dollar for $2 because you think someone else will pay $3 is gambling. For the last few years, we have been gambling. 2026 is the year the casino turns on the lights and asks everyone to pay up. You do not want to be the one stumbling around looking for your wallet when that happens. You have to realize that the financial industry is designed to sell you products, not to make you rich. They want you in the fund so they can collect the expense ratio. They want you to trade so they can capture the spread. They do not care if you lose 50% in a drawdown because they know you'll stay invested. You have to be your own advocate. You have to take control. This means spending a few hours a month actually looking at what you own. Read the annual reports. Look at the balance sheets. If you don't know how to do that, learn. It is not rocket science. It is basic arithmetic. As we move closer to this 2026 horizon, you will see more volatility. You will see days where the market drops 3 or 4% out of nowhere. The news will blame it on some random event, but the real reason is leverage unwinding. The system is fragile. Your defense against fragility is having assets that have no counterparty risk. Gold has no counterparty risk. Real estate, if you own it outright, has no counterparty risk. Stocks have risk. Bonds have risk. Understand the difference between ownership and a claim on paper. I want to leave you with this thought. The greatest wealth transfers in history happened during crises. The Great Depression, the 1970s stagflation, the 2008 crash. In every single one of these events, fortunes were made by people who saw it coming and positioned themselves accordingly. They didn't panic sell at the bottom. They bought at the bottom because they had prepared beforehand. You have the luxury of time right now. You have a runway before 2026 hits. Use it. Do not squander this time chasing the latest meme coin or trying to squeeze the last % out of a tech rally. Prepare your fortress. If you found this breakdown helpful, if it made you think differently about where your money is sitting right now, do me a favor. Hit that like button. It helps get this warning out to more people who are sleepwalking. And subscribe, because in the next video, I'm going to show you the exact 3 sectors I am buying right now to prepare for this shift. You do not want to miss that. Secure your future, stay rational, and I'll see you in the next one.